I've considered selling all of my Ethereum for Bitcoin because that's how bullish I am on the merge. The merge is just a few weeks away and it's one of the most historic days in crypto. The catalyst for this thesis is based on the idea of Ethereum's triple halving, and after the merge to proof of stake, it's also going to be considered one of the largest airdrops in crypto history as you receive new assets on the new proof of stake network. So let's talk about some things to consider, some strategies we maybe can use, and this idea and this thesis of how one day Ethereum could flip Bitcoin. What's up YouTube? Welcome back to my channel. I am Crypto with Nick. I'm a crypto enthusiast and DeFi investor, and today we're talking about the merge just a few weeks away. And at the end of this video, I want you to drop a comment below if you think that this thesis of Ethereum flipping Bitcoin is possible or if you think it's full of shit. Anyways, come join the Discord. I promise it's free. Let's get into today's video. The merge is just a few weeks away, and here's an awesome website that tries to estimate when it will happen. It's called wenmerge.com. It's basically tracking two different things, the difficulty bomb as well as the mainnet merge, and this is when it will transition to that proof of stake network. The difficulty bomb is really interesting because it essentially makes the puzzle that miners have to solve increasingly more difficult, right? Which kind of disincentivizes the proof of work network, which would help them transition to proof of stake. So this can go ahead and shift a little bit, but it looks like we're 10 days out, which is going to put us at around September 14th. But what's really interesting is that same week on September 13th, we're going to get the CPI data, the consumer price index that goes ahead and tells us how bad inflation is, if it's getting better, if it's getting worse. And so I think this is going to be an extremely volatile week. So definitely be careful out there if you're trading any positions, if you're trading on leverage, right? I would expect a lot of choppy waters. Now, I do think that the market has priced in a lot of these macro conditions when people talk about things like quantitative tightening ramping up here in September, but I don't think what people are pricing in yet is this data. So definitely be on the lookout. I think this is going to set the tone for probably the next few months on where we're going to be heading with this market, whether we're going to continue to trade sideways, whether 17 was the bottom and we go ahead and go up or we crash lower. So definitely be making a video once we get some closer to these dates. Now let's talk about the merge and why it could be the catalyst to lead to Ethereum flipping Bitcoin. And it really comes down to issuance, yield, and inflation. You might be aware of projects like Lido Finance, Coinbase, or Rocket Pool where you can stake your ETH and earn a yield, and you earn about 3.94%. But what's really interesting about this is the same inflation that the Ethereum network experiences, meaning you might be staking your ETH and you might be getting more ETH tokens, but at the end of the day, you're really just diluting yourself, meaning you don't really create more value, you're just creating more tokens. If you come over here to something like ethereum.org, we can see that the total issuance rate is about 4.62%. This is the inflation that the Ethereum network experiences every year. This means you need more buys to come in to offset this inflation to not just dilute ourselves every year. We can see here that about 90% of issuance goes to the miner running the execution layer. Remember, after proof of stake, miners are gone. We do not need them anymore. And 10% right now are going to the stakers of the consensus layer. But let's focus on this number here, 90% going to miners. Now miners, they're a business. They might love Ethereum, they might be bullish crypto, but they run a business at the end of the day. That means they have the mining costs, the energy costs, the real estate costs, meaning that when they mine new ETH, they're not necessarily holding on to it for the next bull run like maybe like you or I. They have to sell it, right? They have to put that constant pressure on the market because they have to fund their business. They have to make sure they make payroll. They have to cover their rising energy costs. We've all seen how insane these energy bills are getting, right? So this is going to take a huge chunk of the market away and selling pressure away after we go through this merge. After the merge happens, people have been calling this the triple halving because the inflation supply is getting reduced by 90%. This kind of equates to over 3 Bitcoin halvings. And so if we look after the merge, when we transition to proof of stake, that the total annual issuance is going to be just under 0.5%. And this is going to be a massive deal. Like I said, we went from 4.5% inflation to now just 0.5%. And now if you come back to a service like Lido, it's been said that the APR for stakers after the merge should be around 4 to 5%. This is where things get really interesting because now you're actually creating new value for yourself. Rather than just inflating the network, you're actually going to be collecting the fees as the stakers, and you're going to actually be starting to create actual real value for yourself rather than just diluting it. So now I'm getting really excited that Ethereum could really flip Bitcoin, right? We've taken inflation down significantly, but there's one more thing we haven't really talked about. And almost a year ago exactly, we had the London hard fork, and this is what introduced burning of Ethereum for the fees. And this is where things get really interesting. The next part of the thesis really is focusing on the London hard fork and burning all that ETH, removing it from the circulating supply, because this is what potentially could make Ethereum deflationary. So if we look at the current stats right now, we burn about 0.2 million ETH per year in fees, but we issue about 5.5 million, right? You can see this is massive inflation still. The amount of fees we burn doesn't really matter. But if we simulate the merge, remember issuance is going to down just 0.5%. And now this becomes a possible scenario where the amount burned could outweigh the amount being issued, right? Turning that into that deflationary asset. So right now, we've all seen that the crypto market is very bearish, right? There's not a lot of things going on. Fees on Ethereum are cheaper than they've ever been, meaning the demand for block space just isn't there. So we're not really burning a lot of fees because people aren't really using the network. But if you envision a scenario where the bull market comes back on and a lot of on-chain activity really picks back up, then we could potentially be burning a lot more. And we can easily simulate this. Look at this. If we have about 4 to 5% being provided for issuance rewards, and we take this burn rate, right now we're burning about 0.5% of the supply. But look, if we turn this into 0.6 or 0.7 or 0.8, look at this chart. It just massively starts to deflate exponentially and kind of snowball. And this is kind of what the whole thesis kind of hinges on, that we're going to reduce supply by 90%. We're going to be burning a lot more because on-chain activities could just be picking up. And now we're going to be turning this into this deflationary asset, which has really been kind of classified as ultrasound money. Now let's talk about the merge itself and what can happen, because technically it's going to be a massive airdrop for everyone because you're going to receive new tokens on the proof of stake network. But the question is will any value be retained on the old legacy proof of work network? So let's talk about maybe how to play this game of chess. If we look at something like Ethereum Classic as kind of like a baseline or foundation, we can see that Ethereum Classic is still a $4.5 billion market cap and it's still a top 100 coin. And that's because in the new proof of stake network, we don't need the miners anymore, right? So miners are incentivized perhaps to either reallocate their resources to something like ETH Classic, or there's been a lot of talk and chatter about supporting a new fork of Ethereum that will continue to be proof of work and supported by the miners. So a lot of people are making this bet that the Ethereum old proof of work network could retain some value. So what a lot of people are doing are actually holding as much ETH as possible in their wallet. You won't probably necessarily want to hold this on an exchange because it might not support it, but people have been using projects like Aave and money markets to borrow as much ETH as they can going into the merge, so that way they get as many token airdrops as possible. Now, Aave specifically has taken some actions you can see here to temporarily pause ETH borrowing, and that's because they don't want to end up with a potentially bad debt where something goes wrong maybe with the merge, where they're unable to maybe liquidate assets properly. So they themselves, you can see it's already passed to go ahead and limit this borrowing, but of course this is the strategy a lot of people have been using. Now, I'm not going to lie, it's going to be a complete shit show with the bots. The bots are going to be running crazy, trying to extract any little value they can out of the old proof of work network. But if there's a chance for even us to extract 2%, 3%, 5% of additional value, like, it's worth it, right? It's worth to give it a try. See if we can get some free money here. And so Justin Sun and the Polynex Exchange has been actually one of the biggest supporters that says that they'll continue to support the Ethereum proof of work network. You can see here that they've currently listed ETHW as the potential hard fork IOU tokens. It doesn't necessarily represent it at this time, but they will essentially agree to support it after the fork occurs. And even exchanges like Coinbase have announced that they're open to listing Ethereum proof of work forked assets. And if we take a look here, if we scroll down a little bit, it says at Coinbase, our goal is to list every asset that is legal and safe to list so that we create an even level playing field. And it basically says that should an ETH proof of work fork arise, and that the assets will be reviewed with the same rigor and be listed on the exchange. And if you're looking for some other exchanges that plan to kind of participate and maybe supporting the hard fork, of course we have Polynex, we talked about that. Gate.io looks like it wants to get involved, maybe MEXC, BitTrue. So here's a list that you can kind of consider of where you would potentially be able to off-ramp if you wanted to get involved in this. So something we haven't really talked about is how NFTs also kind of play into this, right? We've talked about how you're going to be airdropped a ton of new ETH and all these other assets on the proof of work network, but this involves NFTs because NFTs really are just ERC-721 tokens. Remember, these graphics are hosted somewhere else. It's really funny because when you think about it, the original NFT, right, is going to actually be on the proof of work network. And now you're going to be airdropped a new NFT token, which is kind of a duplicate or a replica on the new proof of stake network. And now you could argue that the proof of stake is probably going to be the only one that's going to retain any value. because I'm sure that's where everyone's going to migrate. But it'd be really interesting to see if any projects or founder really try to abandon this idea of proof of stake and really want to keep their community on proof of work. I really haven't seen that. I don't have any examples really, but it's interesting because the proof of work is technically the original, but I think we all agree that the social consensus will move to proof of stake. And platforms like OpenSea would make it really hard to support your community and your NFT collection on the old network anyways, because OpenSea has pretty much already come out and stated that they're only going to support the new proof of stake network post-merge. Now let's talk about the merge itself, the actual day. What could happen if something goes wrong? What are things to look out for? If there's going to be any volatility, and should we try to capitalize and buy those dips? Here's something interesting to watch during the merge, essentially the slot visualization tool, and you can see if things are being justified or finalized and how things are performing. Now this post is pretty long, so if you want to come read it, I'll drop the link in my Discord, or you can try and Google it. But basically, we're going to check out Kamikaze's ETH analysis of it, which gives some good cliff notes. And basically what to look at here is 6 to 12 minutes post-merge, we're going to know immediately if there's been any significant issues. And he basically sums this up, and this is really important for traders who are trying to capitalize on this maybe volatility, because basically what could potentially happen is you might have some FUD or some fear that might be able to be taken advantage of, or yourself, right? You can be aware that maybe things are going catastrophically wrong and that you should probably get out. Something to look out for is participation. Here we even have Vitalik himself reminding people to update their clients at the merge's client and to update before then, right? So if we come back here, something to look out for, that if there's a dip in participation and it's above 66% after 6 minutes, we're going to know that everything is fine and that we can buy any FUD dip with confidence. But if participation is sub 66% and finalization isn't achieved, that it might take several hours, who knows, several days to go ahead and resolve this, and that could potentially lead to an extreme dip. The last thing I really want to touch on is this latest news coming out of Coinbase, which could unlock potentially billions for the world of DeFi. And that's because they are now adding liquid derivative of Coinbase wrapped staked ETH. And this is really great because right now, if you stake your ETH with any provider, you're really not going to be able to access it from anywhere between 6 to 12 months after the merge has already completed. And so now this gives people an opportunity to either exit position, participate in DeFi, and do a couple more things. If you're familiar with the Lido and cbETH, this works the same way, where Coinbase ETH is not pegged to ETH, but it's always redeemable for 1 ETH, meaning that the price set by the market on what cbETH is nothing more than secondary market participants, right? Don't worry if it's not pegged, but it's something to be aware of. And of course, I wouldn't expect anything less from Coinbase. We have Open Zeppelin, who went ahead and performed the audit, right? That gives me a lot of boost of confidence. Of course, always do your own research. And the cool thing about this is if you want to get access to your ETH now, you can go ahead and cash it out. There's already a factory pool on Curve, right? So you can actually exit your position completely if you want. You can also provide liquidity. It's earning about 1.5% in base rewards, but we might even see some more Curve emissions directed towards this pool in the near future. But what I think I'm really expecting for here is big money markets, ones like Aave, who already list Lido's STETH, to go ahead and list Coinbase. This is going to allow you to collateralize it and borrow against it, which again, it's going to help unlock billions of dollars. Super cool. Be on the lookout for this. I'm sure someone's writing a proposal. That pretty much wraps up today's video. Let me know if you're convinced that Ethereum one day could flip Bitcoin. Drop a comment below, hit that like button, come join the Discord. See you in the next one. Cheers and happy farming.